Stay tuned after the conclusion of the podcast for additional important information. Visit PIMCO.com for expert analysis and resources to help you stay informed in a fast-moving world. Welcome to Fixing Your Interest. In this episode, we're joined by Yacov Arnopolin, Portfolio Manager and Co-Chair of PIMCO's Emerging Markets Portfolio Committee, and Michael Davidson, Portfolio Manager in PIMCO's Emerging Markets Group. They discuss the rebound in emerging markets, the rise of local currency strategies, and the evolving role of frontier economies. With insights on credit quality, currency dynamics, and political risk, Yacov and Michael highlight how improved policy frameworks and diversified benchmarks are shaping opportunities. Their practical perspectives on macro tailwinds and active management guide investors through today's emerging markets landscape.
I'm Mike Davidson, an emerging markets portfolio manager here at PIMCO, and I'm here with Yacov Arnopolin, another emerging markets portfolio manager. Yacov, it's great to see you here in our London office. I know you've been very busy on the road recently, traveling, meeting our clients in Europe and beyond. What's the mood like?
Well, thanks, Mike, and good to see you and good to be in London. I would say it's quite nice to feel this comeback of emerging markets after many years of concern, of outflows. I always say we had this 100-year storm in EM around 2021 and 2022 because of Fed hikes, ECB hikes, geopolitical events, outflows that naturally led to defaults. And after 157 billion of outflows, a really huge figure, 157 billion over the past 2-3 years. So again, that 21-24 period, we're starting to see green shoots, but it's really still I would say it's just a kind of sliver of what has exited that's coming back. So it feels like certainly there's room for more, and clients are very excited. And a lot of questions both about credit, hard currency emerging markets, about local currency emerging markets, about currencies in particular. I think some of that is on the back of the fact that increasingly the volatility that people witness in developed market fixed income, in developed markets in Europe and the US, is prompting them to ask, where can we potentially diversify into? So we really think the incremental euro or dollar of investments within fixed income is quite likely to be captured by emerging markets. And I think really the debate then becomes, is it going to be hard currency or local currency? And whereas past 1, 2, 3 years, all money coming in, whatever money was coming in, it was mostly our investors kind of changing their managers rather than new funds, as I mentioned. This year, in fact, probably since Liberation Day, it really has become 50-50 with local currency gaining ground. People are really thinking about what are the prospects for EM currencies to continue to perform. So it's very much this push and pull, a little bit of diversification out of the US dollar, and also naturally people thinking about the potential of EM effects of EM currencies. So maybe I can turn to you as our local markets expert. And when you think about macro in EM, and when you think about inflation and growth prospects, do you think that pivot to local currency is justified?
Yeah, it's funny you talk about the tricky period between 21 and 24, because as you well know, for local currency investments, it really has been somewhat of a lost decade. You've seen assets under management tracking the local indices basically stagnant since maybe 2013 or 2014. And really, it's only this year that we're starting to see more interest coming back. And I do think it's the diversification angle that you mentioned. And I think there's been a bit of a change in perception in terms of EM local currency investments. For a long time, they've been viewed as a high-risk part of the spectrum, and the volatility has been much, much higher than other fixed income indices. But what you've seen over the last maybe 2 or 3 years is that volatility has come down at the same time as you've seen volatility in other fixed income indices rise. And so now you're looking much more in line with the pack. At the same time, you're still getting very attractive yields on a lot of your local currency investments. I think this is testament to the good job that a lot of EM policymakers have done over the past 5 or 10 years, diversifying their sources of funding towards their local currency markets, acting proactively during periods of stress to offer higher yields to investors, and being a bit more prudent on the fiscal side as well. There's a lot of concern globally about fiscal policy and governments spending too much money. That feels like a cycle that we've been through in the past in emerging markets, and really policymakers have been taking that very seriously. So you're ending up with deficits and debt levels that compare pretty favorably to developed markets.
And just if we get a little more granular on local currency angle, when we look back, you mentioned the past performance, or at least there have been years where it's been a very volatile beta. The benchmark has been very volatile, but the benchmark has also evolved, and I think people don't appreciate the fact that now with the inclusion of China, India, potentially Saudi Arabia, this is a much less volatile benchmark. Potentially with a more favorable outlook versus developed market rates. Is that fair?
I think that's absolutely fair. The overall returns of the benchmark are no longer dependent on one or two key and very volatile countries. It's a much better diversified index now, I think, and the return streams are a lot more stable. And you've seen that in the falling volatility of the beta. So I think that's something that has attracted people to start reconsidering local markets investments. And there's a lot of countries now that are becoming investable. You have talk about frontier economies, for example, that we as active managers have been looking at investing in. So that replaces some of the yield that you might be giving up with some of these more stable markets.
So can we talk more about frontier? Because on the hard currency side, for us, frontier certainly has been a fantastic driver of returns. Both the underweights and the overweights, naturally a lot of volatility, but generally we certainly have seen a healing cycle over the past several years. A few countries that defaulted have restructured, they have new bonds, they're not paying much in terms of coupon, but that's fine. It also means there's very little probability of a kind of redefaulting anytime soon. So, we're looking at literally all the scope of countries we invest in. There's 70 plus in the hard currency benchmark. There's probably another 10, 15 we invest in off benchmark that may eventually enter the MB benchmark. And when I look across the board, I really cannot think of a single country at risk of default on a 12-month horizon, even 24-month horizon. And there was an industry report recently that took it further and said really no defaults, before 2030, and that's mostly because that's how far this report was, that it was forward-looking on a 5-year kind of horizon. So there is a lot going on in frontier markets. I mentioned a lot of healing, still very elevated yields when we compare emerging market sovereigns to developed market sovereigns. When we compare emerging market sovereigns to corporates in Europe, in the US, they really stand out to me still, especially some of the double B, the single B cohort, as offering a lot of risk premium even after the rally. And as much as we're bond managers, we're always worried about the next crisis, the next recession. Even then, even if we witness a recession in Europe and the US, it's still difficult to conceptualize, other than the natural beta, with credit, to the extent credit widens, everything will widen. But EM wouldn't be the epicenter of that. EM wouldn't be the source of that crisis, of that recession. So will EM get touched? Yes, but to me, there'll be some correlation, but I really don't see that as anything that will be systemic for emerging markets, because how clean the balance sheets have become, because of the IMF support, because of the World Bank support, because they've weathered these crises. But then, I always think in our portfolios about the trade-off between the exposure to frontier via hard currency bonds and frontier currencies. And frontier currencies, it feels like it's a nice way to add a little bit of some spiciness to the portfolios, but those have been great drivers of return. So how do you think about the opportunity set there, and what are you seeing in terms of on the local side, currencies, rates?
I think everything has to be taken on a country by country basis. But what you have seen is a number of countries learn from the mistakes of the past in terms of allowing their currencies to become very overvalued, maintaining fixed exchange rates. And actually, they've fixed a lot of those problems now, and they are offering extremely appealing yields at a low volatility. So I think there's a number
They fixed the problems, they devalued, right?
Not just devaluing was a part of fixing these problems, but hiking interest rates, sorting out their fiscal deficits, making sure they're securing financing at concessional levels from, as you mentioned, the IMF, but also regional partners as well. So a lot of the problems that you had in the past have been addressed in a way that leave these stories attractive to investors. At the same time, it feels like they're a little bit further from the beaten track. Maybe other managers don't have the size and scale that we do to unearth the opportunities and therefore take advantage of some of these yields that are on offer.
It's when we talk about the presence of additional support, and whether we talk about IMF, World Bank, or you talked about regional partners, I think that's what the market and some folks underappreciate is how much things have evolved, both the technicals, but also the geopolitics. We witnessed a couple of years ago, Abu Dhabi threw a lifeline to Egypt, right? So, we're seeing increasingly, it's not just the usual suspects, the IMFs and the World Banks that are able to offer support. There are many more multilateral institutions, the African Development Bank, and so on and so forth, that certainly have the muscle and the balance sheet to potentially support countries in the region. And, well, we shouldn't forget, the U.S. has been obviously quite active in Latin America more than anything, but also beyond. We naturally saw this, the bailout, if you want, or the currency swap, the support offered to Argentina. Relations are very strong between the U.S. and Nayib Bukele in El Salvador. So, we shouldn't discard that as an additional source of potential support. So we look across the globe at who are the allies, and could the allies be rewarded, via, this additional support, these additional swap lines, or something along those lines. So again, it's a complex picture, and I feel like as an emerging markets portfolio manager, you become a little bit of a geopolitical expert because it's not just figuring out the next crisis, but also what other players can be there as a lender of last resort to basically kind of lend a hand if needs be. Again, I think that has been potent. This other topic that you mentioned in terms of the growing sophistication of local markets. What are you seeing, let's say 10 years ago versus now, in terms of in the local market space? How much of that is foreigners versus locals, and how has that evolved?
Yeah, because of this lost decade in terms of offshore investment in local markets in particular, you have seen a lot of emerging market countries develop their own financial architecture to be able to finance themselves. And what many people don't realize is these pools of capital have become extremely large. I mean, I remember you telling me about your trip to Chile recently and really appreciating the scale of the local pension systems, the AFPs there. But it's the same in Colombia.
In Mexico.
It's the same in South Africa. And that's become a really important sort of source of stability for a lot of these markets, because when you have maybe more pro-cyclical investors trading around the markets, you have these deeper pools of local capital that are able to provide bonds at maybe stretch levels, but also, more importantly, perhaps absorb bonds into...
It's a vol suppression.
Basically. And we talked a little bit about volatility already and how emerging market volatility has fallen. This has been an important driver, both the growth of these domestic pools of capital and also then the skew towards issuing in local markets, which has reduced dependency on foreign exchange as a shock absorber.
And maybe a slight pivot to ESG, because this is top of mind for many investors in Europe. As this recent trip to the continent, once again, ESG is front and center. We do a lot on the hard currency side. Very blessed at PIMCO to have a large franchise and a large emerging ESG team that we work with. For you on the local side, is that also an evolution? Is that coming to the fore?
Yeah, it's been an area of real focus and growth for us. You've started to see countries issue more green bonds and labeled bonds in their own currencies. And at PIMCO, we have sort of best practices that we're able to share with these sovereigns when they're looking to develop their green programs. So I think it's a trend that's going to continue. We're still seeing a lot of interest from it from a diverse client base. So I think that it'll be increasingly important as sovereigns look to diversify their financing, that they're able to tap into these pockets of capital which are more ESG focused.
But that brings me to the topic of corporates versus sovereigns. And as much as we see a lot of ESG issuance on the corporate side, we've been fairly careful in terms of how much exposure we want to have to corporates. They're a great diversifier. In many cases, we have far better balance sheets than developed markets. Many of them actually have businesses in developed markets, but they have headquarters in emerging markets and they get penalized. So there's really, I feel we're blessed as EM portfolio managers, as emerging markets portfolio managers, because the universe is so wide and there's so much for us to pick from, literally going from frontier currencies to local rates, FX, hard currency sovereign bonds, hard currency corporate bonds, ESG issuance.
I mean, ultimately, it comes down to liquidity, I think. We always had to be conscious as investors in emerging markets of the liquidity profile of the investments. And I know you and I both spend a lot of time when we look at our portfolio to understand our ability to move the underlying assets around, particularly as the funds grow larger. So I think that's one of the things that, to the extent that the corporate market develops better liquidity and some of these higher rated names, the quasi-sovereign names, have comparable liquidity to their underlying sovereigns. But again, as you get lower down the quality spectrum, you're really not just taking view on the fundamentals of the company, but also in terms of the liquidity of the market.
It's curious. I've been speaking a lot to our corporate credit analysts, and anytime I spend time with them, which is a lot, I always learn something. But also just like the focusing on the details matters, and focusing, different countries have different bankruptcy codes. And as much as, and we talked about Brazil, I think most of us expect that creditors will have preferred status, so to speak, but there are countries with a kind of Napoleon code. In many cases, that's not assured, and sometimes equity may have high recovery. So again, really have to be nuanced and have to look at every single opportunity and look at every single country. Again, I think that's where having a large bench of corporate analysts, economists, PMs has helped a lot in terms of being able to do the work and dig deeper and understand what the real risks are. And again, back to my point, as a fixed income portfolio manager, we're paid to worry, and that's what we do.
Yeah, absolutely. But as much as we talk about worrying, actually the macro outlook for emerging markets is pretty good at the moment. You have a Fed that's been cutting interest rates. You have a dollar that's been weakening, but
which is actually also, it feeds back into corporate credit, emerging market credit spreads, because all of that is quite supportive. Stronger effects, good for credit as well. So people forget that they're both.
Well, the thing about emerging markets is to many extents, it's a virtuous cycle. In all of these assets, they become self-reinforcing, and kind of paradoxically, even though the valuations may look more expensive, it has actually reinforced the underlying macro as well. So it gives the performance of assets a little bit more durability, a little bit more runway into the future. You think about stronger FX leads to lower inflation, allows central banks to cut interest rates, which means that government financing costs are lower, which means that the corporate sector is not getting crowded out by government issuance. So all of these things kind of feed on each other and allow more runway. I mean, it was the same dynamic in reverse in the challenging period that we saw, and the fact that emerging market sovereigns managed to weather that period of extremely tight financial conditions, strong dollar, default cycle, they've come through the other side now, and many of these countries are well placed to reap the rewards of the virtuous cycle that I think we're seeing. And the diversification of global investors who own a lot of US assets, and it's been a great trade for many years. But as they're looking to rebalance their portfolios, maybe pivot a portion of that away, emerging markets, again, are poised to benefit from those flows as well.
All right, so I'm going off script here. Unsolicited questions. Speaking of the dollar, I think something that comes up quite frequently is, can EM currencies do well if the dollar sort of grinds weaker, just kind of stabilizes at current levels? What's the argument then for EMFX?
Oh, absolutely. I think that's a great environment for EM currencies. Ultimately, EM currencies, one of the reasons that people invest in them is because of the carry. And the best environment for a carry trade is a low volatility environment. So to the extent that the dollar stays where it is, grinds weaker, but in a stable fashion, that's a very benign environment for emerging markets, and you're likely to see the highest yielding parts of the emerging markets universe do particularly well. But that rising tide should lift all boats. I mean, in many ways, that's a better environment than one where you're seeing sharp dollar weakness, which could be linked to maybe US economic weakness, and growth shocks can typically be negative for riskier assets. And emerging markets, we discussed before, maybe unfairly, but they're very often bucketed in that part of the universe.
Yeah, it's something that I always try to differentiate as well. Those of us focusing on credit or just hard currency bonds, there is a little bit of I guess there's a sense of mean reversion, or that maybe things ultimately repay at par, maybe they go above par if yields really rally. But there is this notion that things will mean revert, and ultimately there's that sort of gravity. And it's quite distinct with currencies, right? Currencies are not necessarily mean reverting. Currencies can run much further, assuming the fundamentals are justified, and in the meantime can also offer a lot of carry.
Yeah, absolutely. And I think one of our jobs as portfolio managers is putting the pieces of the puzzle together. So looking at the valuation of the currencies on various metrics, looking at how the performance of the currency is interacting with the balance of payments. So an overvalued currency might mean that your imports start growing very fast because it's cheaper to import goods rather than to produce them domestically. And it's our job to look for when these imbalances are starting to grow, and then maybe question sustainability of the currency performers. But really what we're seeing at the moment across emerging markets is the external balance sheet is mostly in good shape. There's a few notable examples where that's not necessarily the case. But on the whole, balance of payments, I think, looks really good. And that, again, gives me confidence that emerging assets can continue to perform on both the local currency side, but then, as we've discussed, local currency assets doing well is really supportive for credit as well.
So maybe that's a good pivot in terms of let's talk about next 3, 6, 12 months. Favorite places to where do you have a favorable view? Which countries, which currencies, which bonds?
Look, I think our playbook this year has really been look for two different types of trades. The first is these places where there's been a big shift in policy towards cheaper currencies, higher yields, and then stable FX afterwards. And that's mostly played out in the frontier space, so Egypt and Nigeria. But another place that's really played out has been Turkey. There's been a very concerted effort to get inflation down, offer high yields to generate FX stability, both for offshore investors, but also importantly, domestic investors need to be given confidence to reinvest in the Turkish lira and their own currency. So that's been a very interesting space. The other sort of big theme in terms of trades that we've liked has been places where there's been a benign inflation trajectory, low inflation, but also steep curves. So that's been one place where we've sort of looked at Peru, for example, and South Africa, both places where inflation has fallen dramatically. South Africa actually lowered their inflation target, or they preferred to call it a preference to see inflation settle at the bottom of their inflation targeting band. So they've moved that from 4.5% to 3%. And that obviously has had very positive implications for how investors think about medium-term bonds in South Africa, because you're now expecting inflation over the medium term to be 3% rather than 4.5%. But maybe I'll throw that question back to you. What are the sort of top of mind trades for you, but also how are you thinking about political risks as you shape your portfolio?
Yeah, of course. Well, also a lot to do on the hard currency side. It's been an exciting few months and it remains quite interesting to observe. Also, curiously, as countries that have been locked out of capital markets are able to re-enter capital markets because the yields are lower, it really becomes a virtuous cycle. So it's a little counterintuitive. People normally would say, well, there's going to be an extra 2, 3, 4, 5 billion issued in the market. That should put pressure on existing bonds. In reality, for some of the high yielders, it actually prompts a rally in their existing paper because of what's done after 2, 3, 4, 5 years being locked out of capital markets. That's yet another source of financing that has just reopened. And we witnessed that in Egypt, in Angola, in Nigeria some time ago. So again, it's actually fairly positive. So for us, what has worked very well, been quite positive on Angola. That has been a very nice trade. I think they continue to do well. Now there is more sensitivity to oil prices there. Really, to me, having this active management approach and having a large team has really helped us as well. And then your question about political risk. Well, this is where we're always worried, and we try not to take a view in politics, because these days polling is and ultimate results can really diverge, and all these elections can be quite unpredictable anywhere in the world. But generally speaking, we may see a net favorable transition next year. We're going to have elections in Chile. We're going to have elections in Brazil. So, it's still a very busy calendar. Now, I think that's going to create opportunities. So it's kind of always exciting times, exciting times in emerging markets, lots to do.
Yeah, that's for sure. There's always something to look at. There's always something happening. But it's great to be feeling like we're in a spot where things are going well and there's good runway for assets to continue to perform. Thank you very much for listening, and we hope you found it interesting.
Thanks for listening to Fixing Your Interest. Today's episode explored the momentum in emerging markets, from FX stability and frontier recoveries to macro tailwinds and political transitions. We examined how evolving benchmarks, local capital pools, and active strategies are reshaping the landscape. For more perspectives on global fixed income, subscribe to Fixing Your Interest, share this episode, and visit PIMCO.com for expert analysis and resources to help you stay informed in a fast-moving world. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.